A new banking safeguard tied to a specific dollar amount has now been put in place. And if you receive Social Security, a pension, or any kind of government benefit, this update is already unfolding and it applies to you starting now. My name is Lisa and you are watching Future Bridge USA. What we are going over today is exactly what this safeguard does, who it affects, and the steps you should take so your money stays protected and fully available every single month. Stay with me through the entire video, because the details that appear in the second half are the ones most people overlook, and skipping them could genuinely cost you. Let us begin at the start. Regulators and financial institutions have introduced an updated banking compliance framework, and at the center of it is a $250 threshold that banks and credit unions across the country are now expected to use under certain conditions. Before anything else, let me be completely clear with you. This is not a cut to your benefits. It is not a new fee being added to your account. It is not a restriction on how you choose to spend your own money. What it actually represents is a much stronger layer of financial protection built specifically to help shield everyday Americans, and seniors in particular, from a surge in fraud that has been targeting retirement income with alarming accuracy. Here is why this safeguard exists right now. Financial criminals have become extremely calculated in the way they go after older adults. They know the exact days when Social Security deposits reach accounts. They know when pension payments arrive. They time their attempts to begin within hours of those funds landing. And by the time most people realize what happened, the money has already moved and getting it back becomes a very difficult process. Regulators studied this pattern and responded with a structural update designed to interrupt those attacks before the damage is done. The $250 monitoring threshold is one of the main tools now built into that response. So, what does this safeguard actually require banks to do? Financial institutions are now expected to apply enhanced monitoring procedures to certain transactions that meet or exceed $250 under defined circumstances. Think of it not as a barrier, but as a motion-sensitive system that turns on when something unfamiliar enters the frame. Your everyday purchases, your monthly bill payments, your utility transfers, your rent payments, your pharmacy charges, all of that continues without interruption. The monitoring layer is not watching for normal behavior. It is designed to identify patterns that fall outside your usual account history. Here is a clear example of how that works. If your account has followed a steady pattern for months or years, with consistent deposits arriving on schedule and consistent bills going out in predictable amounts, the bank system forms a recognition of that routine. It becomes your financial signature. Now imagine someone gaining unauthorized access to your account shortly after your Social Security deposit lands. They try to send several fast transfers to accounts that have never shown up in your history, in amounts around or above $250. That is exactly the kind of activity this safeguard was created to stop before those funds leave your account for good. You may be asking whether this will interfere with your daily financial life. For the vast majority of seniors living on fixed income, the answer is no. Regular spending habits, standard bill cycles, and ordinary withdrawals do not trigger the enhanced review process. The system is tuned to flag unusual activity, not normal patterns. Seniors who keep predictable account behavior are statistically the least likely to experience any kind of interruption at all. Now, let us talk specifically about Social Security, because this is the benefit most directly connected to what we are discussing today. Retirement benefits, disability payments, SSI, and SSDI are all still processed on the same federal deposit calendar they have always followed. If your payment comes on the second Wednesday of the month, that does not change. If yours arrives on the first, that does not change either. The $250 safeguard does not touch payment amounts. It does not change eligibility. It does not move deposit dates. What it does is create an added security layer over your account once those funds arrive, making the period immediately after deposit significantly safer than it was before. The same applies to pension income, whether it comes from a private employer plan, a public retirement system, or a federal program such as railroad retirement. Cost of living adjustments remain calculated by federal formula and continue to flow through exactly as determined. This safeguard works in the background as a protection, not a barrier. Let us take a moment to look at why older adults have become such a concentrated target for financial fraud in recent years. The numbers are truly concerning. Reports of financial exploitation against adults over 60 have risen sharply as banking has shifted more deeply into digital environments. Criminals use phone calls, text messages, fake government letters, and psychological pressure to push older adults into making rushed payments. They create urgency. They invent deadlines. They pretend to be Social Security Administration employees, Medicare representatives, or even family members claiming to be in trouble. The common thread in nearly every scam is speed. Fraudsters need the money moved before the victim has time to pause, think, or contact someone they trust. The $250 monitoring threshold slows that speed by adding a checkpoint in situations where fast and unusual transfers are detected. That brief pause is often enough to stop a scheme from succeeding. For a senior living on a fixed monthly income, where $250 represents a meaningful part of the budget, that pause can be the difference between a narrow escape and a serious financial loss. Regulators have been clear that this update is part of a broader modernization of consumer financial protections across the country. As digital banking keeps expanding, the tools used to protect account holders have to keep pace. Banks are no longer just physical locations where tellers count cash. They are large digital systems handling millions of transactions every day. Automated monitoring allows those systems to provide consistent oversight at a scale that no manual review process could ever match. This raises an important practical question. What actually happens if one of your legitimate transactions is flagged? First, stay calm. It is uncommon for people with steady account behavior, but it can occasionally happen. When it does, your bank is now required under the updated framework to contact you quickly and clearly. You may receive a phone call, a text alert, or a message through your online banking platform asking you to confirm the transaction. Verify your identity through the bank's secure channel and confirm that the transaction was yours. In most cases, the review ends quickly and your funds remain fully intact throughout the process. It is important to understand that a review is not an accusation. It is not the bank saying you did something wrong. It is a safety checkpoint working in your favor. Responding calmly and cooperatively helps the process move as quickly as possible. And if you ever receive a call or message claiming to be from your bank and something feels off, hang up immediately and dial the number printed on the back of your debit card. Never give personal information to a contact you did not personally initiate. Now, let us talk about seniors who prefer in-person banking over digital platforms. If you handle your banking at a physical branch, your experience there does not change. You walk in, speak with a representative, make your deposits, handle your withdrawals, and ask your questions exactly as you always have. The monitoring systems behind this safeguard operate entirely within the bank's internal infrastructure. You will not be asked to sign new documents, complete a fresh enrollment, or take any extra steps at the counter simply because this update has taken effect. The changes are structural on the institution's side, not procedural for you as a customer. For those who use online banking or mobile apps, which a growing number of retirees now do for the convenience they offer, this safeguard works alongside the security features already built into those platforms. Two-factor authentication, real-time deposit alerts, and activity notifications remain exactly in place. The $250 monitoring threshold adds an additional protective layer on top of those existing tools. Together, they create a more complete security system that helps guard your retirement income from multiple angles at the same time. Here is something that deserves close attention. This update also has implications for joint accounts and accounts where a caregiver or family member has authorized access. Joint accounts between spouses who regularly make transactions together will usually show a broader but still recognizable activity pattern. As long as that shared activity stays consistent, meaning similar types of transfers going to familiar recipients at predictable intervals, the monitoring system reads it as established normal behavior. Where review is more likely to be triggered is when a newly authorized user begins sending different types of transfers to unfamiliar recipients in rapid succession. If you have recently added someone to your account, or if your banking patterns have legitimately changed for any reason, it may be worth visiting your branch and having a brief conversation with a representative. Let them know about the change in context so your account history is accurately understood. That small conversation can prevent unnecessary confusion later on. This is also a good time to think about communication within your household or family. Retirement finances are not always discussed openly between spouses, adult children, and aging parents. But transparency about regular expenses and approved transactions creates a clearer picture of what normal looks like in your account. That clarity helps bank systems distinguish between your legitimate activity and any unauthorized intrusion. It also protects caregivers and family members who help manage finances from confusion if a routine transaction is ever flagged for verification. Think about what proactive protection really means in practical terms for a senior on a fixed income. Someone receiving $1,400 a month from Social Security is operating within a carefully structured budget. Rent, utilities, prescriptions, groceries, and perhaps a small contribution towards something for a grandchild. Every dollar has a place. An unauthorized withdrawal of $300 in that situation is not a minor inconvenience. It is a month thrown into disarray. It is a prescription delayed. It is a utility bill paid late and a late fee added on top of that. The emotional impact of discovering that kind of theft adds to the financial damage. Prevention at the moment of the transaction is worth far more than trying to recover money after the fact. Recovery processes are slow, legally complicated, and rarely lead to full reimbursement. The philosophy behind this update is to stop the theft at the source rather than chase it afterward. The $250 threshold gives banks a defined activation point for that real-time response, and that is a fundamentally different and better approach. Some viewers have reached out to ask whether this safeguard is connected to any upcoming one-time federal payments or economic relief distributions. Here is a straightforward answer. If federal authorities authorize any form of supplemental economic assistance, those funds would be deposited through the same Treasury infrastructure used for regular benefits. The monitoring safeguard does not block those deposits, does not delay them, and does not reduce their amounts. What it does ensure is that once those extra funds arrive in your account, the same enhanced security that protects your regular monthly income also helps protect them. If anything, larger one-time deposits benefit most from this kind of oversight because their arrival creates a higher value window that fraud attempts often target directly. It is worth addressing a concern that comes up often when banking regulations are discussed in the context of older adults. That concern is the worry that rules like this are designed to restrict rather than protect. That concern is understandable. Seniors have sometimes been treated as secondary considerations in financial policy decisions, and that history creates real skepticism, but the framing of this particular update is genuinely different. The stated intent in the regulatory language is consumer protection with direct emphasis on vulnerable populations. Seniors are not the people this safeguard is aimed at stopping. The target is fraud and criminal activity, and the tools being used are calibrated to interrupt that, not to limit the account holders being served. As you continue watching, think about how everything we have covered applies directly to your own situation. Whether you receive one federal benefit or several, whether you bank in person or online, whether your account is individual or shared, the core principles remain the same. Your income is stable. Your benefits are protected. Your right to access and use your own money is fully intact. What has changed is that the financial system watching over your account has just become much more capable of defending it. Here is a practical step worth taking after you finish watching this video. Log into your online banking account or call your bank and review your current alert settings. Most institutions allow you to set real-time notifications for deposits, withdrawals, and transfers above a threshold you choose yourself. Turning on those alerts puts you in a position of immediate awareness. You will know the moment any transaction happens in your account, which means you will also know right away if something unfamiliar appears. Pair that personal awareness with the bank's own enhanced monitoring system, and you have built a very strong defensive setup without needing any technical background at all. A second useful step is to confirm that your bank has current and accurate contact information on file. Your phone number, your email address, and your mailing address should all reflect where you actually live right now. Since banks are now expected to notify you quickly when a transaction review is started, having correct contact details ensures those notifications reach you without delay. An outdated phone number could mean a security alert sits unanswered for hours. When timing matters, that gap is the last thing you want. A third step worth taking is to keep a simple written record of your regular monthly expenses. Nothing complicated, just a basic list of the bills you pay, the amounts, and the approximate dates. If a transaction is ever flagged and you need to confirm that it was authorized, having that reference on hand makes the conversation with your bank faster and less stressful. It also gives you a reliable way to spot anything unusual when you review your account statement each month. These are small habits, but they carry real weight in protecting your financial security over time. Now, Let us bring everything together and focus on what matters most for your peace of mind going forward. Retirement is supposed to be a time of stability and well-earned rest. You spent decades working, contributing to programs like Social Security, and making financial decisions with your future in mind. You rely on that income now, and you deserve to receive it without interference. You also deserve a banking environment that actively works to defend what is yours. The $250 safeguard is one clear example of that protection being put into action. Financial modernization can feel confusing when it arrives wrapped in regulatory language. But when you strip it down to its core function, this update is about one thing and one thing only: protecting the money you depend on from people who are actively trying to take it. The method is advanced, but the purpose is simple. Knowing that your bank now has sharper and more responsive tools to carry out that purpose should bring you reassurance rather than concern. If this video gave you clarity on something that felt confusing or uncertain before, take a moment right now to hit the like button. It helps more people find this information when they need it most. And if you know someone in your life, a neighbor, a sibling, a parent, a friend who receives government benefits and could use this kind of clear, honest breakdown, share this video with them today. Here on Future Bridge USA, everything we do is built around making sure you have accurate, straightforward answers to every financial update that affects your retirement. We are not here to create alarm. We are here to give you the information that keeps your income steady, your account secure, and your confidence grounded. No matter what regulations appear in the months and years ahead, the financial landscape will keep changing. New safeguards will continue to surface as digital systems grow more complex and as fraudsters look for new methods. But the foundation of your retirement security does not waver. Social Security remains intact. Your pension remains intact. Your legal right to manage your own finances is fully preserved. What has shifted is that the protection around those funds has just taken a major step forward, and that is information worth sitting with, sharing, and feeling truly good about. Stay informed. Keep your banking habits consistent. Make sure your institution has your updated contact details and carry forward the knowledge that the oversight now being applied to your account exists entirely for your benefit. That is the complete picture on the $250 safeguard. It is protection, not restriction. It is progress, not punishment. And you deserve both the clarity to understand it and the confidence to move forward knowing exactly where you stand.